So I'd like to show an example, and it's a real life example of how we use some of the things that we teach in the price risk management course. This is an example on soybeans. Many people will be aware of what happened in the soybean market this year. And I'm going to go back to last June and talk about what the market was telling us at that time and how we can use some of the information in the course to make decisions about pricing. People will be skeptical about this, and I can guarantee you that there is actually a YouTube film of me actually saying the same thing last June that I'm saying now. So I did use it then. This happens to be a chart of the March 2019 soybean futures contract. I would have been using the November at the time, but it's gone now, so I can't do it. So I'm using the March. And we cut it off at the beginning of June. And we had observed from the beginning of March until the beginning of June that the market had gone up and challenged that $10.50 area on the chart up here. It tried to get through it in April. It tried to get through it again a little bit later in April. It came up and touched it again late in May, and then it started to back off. So first of all, we're going to call this line up here a resistance plane, and the market has been resisting all that time going through there. My interpretation of that is that given all the supply and demand information that we had at that period, that point in time, it couldn't find an excuse to go higher than $10.50. So we need to change. We need to see a positive fundamental change in order for it to get there. We had some problems in South America, especially with the Argentinian crop here. We had really good exports to China, interestingly enough, that kept the prices fairly high. That caused the rally in May, even though the U.S. was now beginning to plant a record-sized crop. So a whole bunch of things were happening in here, and we were saying this is a really good point to do some pricing based on that resistance plane. It's not the only thing on the chart. What we have up here is something called the MACD, the Moving Average Convergence Divergence, and the Relative Strength Index. Both of them measure momentum of price change. And what you see on this chart, and it's a major signal for me when I see this, is during that March-May period, the futures market's going sideways, but the momentum measures are going down. And you can see that they're both going down. We call that divergence. We call it bearish divergence because it indicates that most likely this market's going to go down from here. So I put all three of those things together. The bumping up against the resistance plane and the divergence on both RSI and MACD to say this is a good place to sell.